Welcome to Rogue Trader. Please read the disclaimer and remember that prices can go down as well as up. Hello and welcome to my stock update for SOFTCAT plc. This is a company that I first purchased in June last year. SOFTCAT are one of the largest IT infrastructure service providers in the UK. Their business consists of 4 pillars: hybrid infrastructure, that's modernising and the digitalisation of companies with cloud networking, etc. Digital workspace, cybersecurity, and IT intelligence. SOFTCAT had shown progressive increases in their revenues and net income over the last 5 years, and they've done this through an impressive organic growth model. They're a good play on the increased IT and digitalisation of companies, and they have a really nice progressive dividend policy, paying 40 to 50% of profits out as dividends as their set policy every year. You can see that they've built up now quite a nice network to cover the whole of the UK and Dublin in Ireland. And they've just recently begun to open branches in the US, Netherlands, Singapore, Hong Kong and Australia. So they're going to begin to sprout out this organic growth policy in these areas as well. So this was how they looked when I did my initial analysis video and then ended up buying them. They initially listed on the London Stock Exchange in November 2015. And there wasn't so much any big news events, but the share price had gone up in this nice gradient, and that coincided with consistently releasing improvements in their revenues. Now, in the year before I bought them, they had just opened a new office in Birmingham, as well as 4 new international branches from which they were going to sprout out some organic growth. And then the news that had just happened at the beginning of 2020 was we had the COVID crisis begin, and they actually cancelled their interim dividend as a response to that, although a lot of companies were doing that as well in a kind of knee-jerk reaction. But despite this, I still invested in them anyway, because under the bonnet they looked really good to me at the time. So here in June is when I did that initial video, and the share price went up, and then they looked quite unloved for a while, and then it really has been shooting up at a nice gradient ever since December. Now, after I bought them, the first thing was their trading update in August. Now, in this trading update, they said that they projected their profits for the full year 2020 to be ahead of the board's expectations. And they also announced that the interim dividend they were going to pay anyway, after all. So this was obviously a very good full year 2020 trading update to start things off after my purchase. Despite this, everything is going great. Ferrero Rocher style trading update. I was then surprised to see their share price dropping, but all the time I wasn't really worried, because I knew from my research plus that trading update that they were well worth hanging on to. So the next news was when they came out with their full year report for the financial year 2020, which ended in the end of July. So for companies you own shares in, I do think it's always very important to read thoroughly their annual reports. In the Chief Executive Officer's statement, there was some really interesting discussion along there about the importance of their account managers, and it kind of gave me insights into how this company's organic growth strategy work. Now, when you think about it, the customers for this company are actually the IT executives that you have on every board of every company, particularly middle-sized and larger ones. Now, these IT executives, they obviously want to have more money spent on IT, and they want to transform their companies into being more IT focused, more digitalized, more modern in terms of their IT setup. Now, sometimes I imagine the board of a company will want to invest in cloud computing and will want to invest in hybrid infrastructure in order to compete better with their competitors if they're aware of this. But I'm often, a lot of the time, really they won't be so aware, and the IT executives will find themselves trying to sell the idea to the board of the companies they work at. Now, where SOFTCAT come in and where their account managers come in is their account managers are building relationships with these IT executives and all these companies, which are the customer base. And over time, they're providing them with, maybe some slides, but basically the business case. This is why you need to modernize your company. And I think then that what happens is when the boards are ready to, or if IT executives manage to convince their boards to go digital and go into the modern age with their IT infrastructure, then following that groundwork that the account managers have done, SOFTCAT are ready to go in, get a contract set up, and then once that contract is signed, the SOFTCAT bring in their geek squad to come in and then set up all this infrastructure. And SOFTCAT are very much a service provider company more than anything else. So I feel like I got a better understanding of how SOFTCAT operate in terms of their sales. And it really does make sense to me how they've managed to organically grow their sales all through their sales contacts and their sales network, and then having the backup with all their technical bods. It makes them a very credible company in the IT space. It all makes sense to me how they've been able to successfully increase their revenues repeatedly year after year, from understanding how they operate a bit through their account managers. So yeah, this is something I learned definitely above where I was last time I looked at this company. And that's why it's always good to look at the annual reports. Looking at their KPI, it was noteworthy that their customer base has increased by 300, and their gross profit is up 70% year on year. So that was a nice positive. So here there's a bit of detail in their annual report about what they do. So I look at the hybrid infrastructure as it's kind of a buzzword really, but from what I make out, you have some things in the company, people's computers and systems they have on site and maybe in-site servers. And then you also have a move towards cloud computing, where people at different sites in the business connect to the cloud kind of network. And this seems to be called, and whatever else, well, I've got it wrong, but generally this whole thing is called hybrid infrastructure. This hybrid infrastructure is the new IT infrastructure that modern companies are building, I guess, to be more efficient in what they do, but also to have strategic advantage over their competitors. The digital workspace, I think that's partly, it could be partly things like, now with COVID, people working from home and stuff. But I think it's also things like having apps and software on people's tablets and on their mobile phones, so that when they're working, maybe not even in the office, they perform functions that then connect to the business in real time and enable them to work a lot more efficiently than before you had this IT capability. Now, we obviously all know what cybersecurity is, and it's good to know that that's something that SOFTCAT do, because there's been lots of hacking scandals in the last few years. So I'm sure it's a good thing that they can make money from. And IT intelligence is, I believe, being able to use all kinds of data inputs like their websites and also apps that they have in their stores, in company stores and stuff, to build up intelligence and then respond to that with the supply chain and stuff. And also just to provide the management with really useful information about where their sales are, where their supply chain holdups are, and all this kind of thing, to improve the efficiency of the business against their competition. So that's kind of just my summary, what I thought it is. But generally, I feel like I got a good enough impression of what they do here. But I do think I've got a fairly good impression, enough to understand that I think that SOFTCAT are well positioned when you look at how, in this modern digital era, companies are investing in their IT infrastructure, and I think that SOFTCAT are well positioned to support that. So looking at their profit and loss, and you can see here a really nice growing income and expenditure in control, and their operating profit and net income growing. It stepped up from 2019 68 million to 76 million in 2020, so that's a really nice 12% jump only the last full year. So yes, this is a picture of perfection really, in terms of their nice and steady growth in income and net income. And we see a nice widening in the gap between their income and expenditure, and then their net income increasing, very nice. I couldn't really see anything spectacular to mention in any patterns between their different revenue sectors of software, hardware and services, but you see it here. It is at least all going up, at least in the last year. So in terms of their assets, there's nothing complicated that I had to look into really, but their net assets are growing nicely. They've doubled roughly in the last 6 years. And nice to see them piling up the cash, up to 80 million now in cash. This lease liabilities thing here is a new IFRS accounting standard that all companies, same with all companies, you've seen this appear in all the companies I've been looking at. But apart from that, they have virtually no debt. And of course, as you know, I love companies with no debt. Now, in taking a look at SOFTCAT, I really did learn a lot about equity and valuation. And I noticed that I've made a few mistakes actually in my previous video I did on frontier developments. So the first thing is, I'd always been looking at this equity in the past. I never really did quite understand it. I kind of knew it was what the equity in the company meant. But what I've come to understand is actually the equity of the company is exactly the same as the net assets of a company. So this is actually quite different to what I thought it was before. And really the equity of the company is, this is the value of the company really, which is why it's exactly the same value as the net assets of the company. But the difference is with the equity statement, they get that through these more equity related treatments or baskets. So in the case of SOFTCAT, most of it is from the retained earnings. Now the retained earnings are a particular accounting treatment of all the money that a company's made every year that wasn't paid out as dividends, but was actually reinvested into the company. So when we look at the assets, the money that was reinvested as capex or as property, plant, as equipment, that goes in as retained earnings. And also perhaps cash that they've banked, that could go back in as retained earnings. So yes, so it's good to know that for SOFTCAT, most of their equity is in retained earnings. Other than that, it gives me a nice profile. Sometimes you get like really complicated things in, and then I'd perhaps want to steer away because it's harder to understand. But yeah, for SOFTCAT, all I can say with my new understanding around what equity actually means is it's mostly retained earnings, and that's good. But yeah, other than that, a big learning point for me is that the net equity is just the same as the net assets of the company. Now, what I've then gone on to now in my trying to understand valuation is I've got here the market capitalization of the company. Now, the market capitalization is the value of all the shares that there are of that company times the share price. So this tells you how does the market value the company, what price people are prepared to pay for shares in the company. So that gives you the market valuation, the market capitalization of the company. But how does that compare to the real value of the company if you were to just liquidate it tomorrow? And we see that the net income of the company, which would be also the price to earnings ratio, very crudely, is 40 to 1. So actually the market cap of the company and the share price is 40 times actually the value of their earnings every year. Then when we look at the net assets of the company, which is also the total equity of the company, we see that the ratio is 22 to 1. So the market capitalization and the share price values the company 22 times their net assets, all the way down here on this chart. So yeah, so actually you could say they're 22 times overpriced what you'd get if you were to liquidate the company tomorrow. Now the revenues are actually about a third the market cap, but I'm never so impressed with revenues. I always go into net income as more important to me. And so this is very humbling for me. You know, I've definitely got a better grip on this than all my other videos, which are basically got big holes in the equity part. And sorry about that, but I'm learning. As I always say, I'm learning as I go along with these videos. But really, my learning point here is that markets are always very overpriced. And I mean, here's the FTSE, and the big humbling truth for me is that when analysts talk about how I value this company, is it undervalued, is it overvalued, the sick fact is that all prices, that most stocks are massively overvalued all the time, and the stock market is as a whole overvalued all the time. So this means that when you're trying to value stocks and try and decide, is this a good share price or a bad share price, you've got to realize that all share prices tend to be overvalued. And so really all I can do is try and have a look over the last 5 years as some kind of indicator, but then also think, well, okay, what is the overall stock market sentiment? So I do that. So I do that in my macro analysis, and I do think it's important to consider as best you possibly can, as much as it's mission impossible. Do I think the stock market is going to go up or down generally based on macro factors, and then you then decide what percentage of stocks do you want in your overall portfolio. And then also sector comes into it as well. So is the particular sector you're stock in something that's generally on an uptrend or a downtrend? So those are things to think of. And then the only thing you can then do is compare your stock with the other stocks in the same sector, and compare the valuation metrics. The answer is everything's overpriced anyway, and you've got to try and make the best guess you can, even if you were an expert. But at least I've got a better understanding. At least I understand that you can't perfectly value. because of those limitations of fact. I think that the reason for that is that there's always only a limit to how many companies are in existence, but there's always loads of people who want to invest in stocks, and loads of pension funds and loads of money out there to invest in stocks. So that's why you're always going to have inflated market capitalizations versus the actual real value of companies. And that's how I understand that. But given that understanding, it's good that I've learned what I have learned from doing this in previous videos, and I'll continue to do as good a job as I can, and I'm sure I only get better at trying to second guess how well is this share price for a given stock against their values, but then also compensating for market sentiments as well. Looking at the past 6 years history of this company, and we see that the net income is actually up threefold, but the market cap is up sixfold. So actually you could say that we were doubly overpriced there from that viewpoint. But we see that the biggest divergence has happened in the last couple of years. And in terms of their net assets, they're up twice. So in that case, it would be 3 times up. But for a company like SOFTCAT, where they're a service company, more than like a commodity stock or something that would have loads of assets, I do think I'd be more interested in the trend in their net income. And yes, it does seem to be the share price led market cap does seem to have diverged by a factor of 2 over the last 5 years. And then when we look at these ratios against the other companies within the same sector, they look on the pricey side, but I wouldn't say too out of whack. I know that I looked at Kainos, and Kainos are very similar to SOFTCAT. I did a video on Kainos actually that you'll find, as well as my initial video on SOFTCAT. And what I can say is Kainos were kind of very similar to SOFTCAT, but SOFTCAT I thought were a lot better because they relied a lot less on the public sector. It's good to note this divergence here. So that's well worth keeping in mind. And then I also have to bear in mind how healthy are the company overall, and how are they fitting to my initial investment strategy for this company. So looking at this statement of cash flows, and it's very nice and simple for SOFTCAT. They have 64 million coming in for normal activities plus 0.2 million MISC to bringing 64 million of cash every year. And then they're spending 2.2 million to rent out their offices, about 8 million on reinvestment in property and capex and stuff, and 1 million in intangibles. And then this has allowed them to pay out 52 million in dividends. Very nice. I love companies that pay back big dividends to their shareholders. And then you take away that from that, and you see how they have about 1 million left in cash every year, which they then goes into their sizable coffers. Now, I did listen in to their latest investor update call that they had, and they produced this slide where you see how, as their customer account executives gain more experience in the company, you see the money they generate per customer increasing very nicely. And we see that this trend has continued in the latest full year and the latest half, actually, from January 2020. And this organic growth that I was talking about with their customer sales guys, their account managers. And also, they did say in their investor update that they'd recruited 190 more of them. So that is very encouraging. I'm imagining them guys getting out there, building relationships, and hopefully we should start seeing even more sales and revenues going forward. As long as they keep these, I can look at these KPI every time they do an update, and as long as this pattern increases, I'm going to be a happy shareholder. And then this other one they produce in their investor update call, it did plateau a bit. This is the number, their customer base, but it's still up despite COVID. And again, this is good information that I can, if I take the trouble to listen into their investor updates, which by the way you can access via their website, and only 98 people had bothered to do it based on the counter there when I did this myself. I can use that information to help keep track of how they're doing on their KPI. In terms of the valuation metrics that are provided that you can get straight off the London Stock Exchange website, if we look at price to earnings on this one, there's two of them actually, but on this one they seem fairly reasonable against their competitors. We've got CompuCenter there at 27.5, SOFTCAT at 36.1. In terms of enterprise value to EBITDA, they perhaps look slightly on the expensive side on that one. In terms of price to book, they do look expensive versus all the other ones. But as I said before, I'm not sure how much capex laden these other ones are. I do know that I had a good look at Kainos, and Kainos are very similar to SOFTCAT, and they are slightly more expensive actually. So price to cash flow, they do look expensive. And price to sales, they look, I'd say, reasonable. And on this other one you can get, their price to earnings per share, they look fairly mid-range against these other ones on this in this comparison. So here's a look using daily candles of the SOFTCAT share price. Here's when I bought them. And as you can see, they've done particularly well, and particularly since December. And then this year, they've been on a real good, clear upwards trend. And I've even made a nice trading channel here. So this looks very bright, very good at the moment. So to summarize, SOFTCAT are really going great guns. And in this health check I've done for them, I'm very impressed how they're progressing. These to me are a long-term hold. I'm going to hang on to these unless some of the fundamental risks identified or their financials start to look strange, and then I'll reassess. Now, in terms of macro strategy, because I'm only 28% in stocks, I'm planning to just hold on to the stocks I have, and I'll just ride through any crash there is. Now, in terms of financials, I'll be looking at that trend in revenue and income and net income growth, and I just want to see that progressing organically and gradually over time. And in terms of risks, the main risks I could think of is if there were some long-term structural damage to the UK economy that then meant that companies just was in such a bad way that they weren't investing in IT because they're just trying to stay solvent. That's probably could be a case more in just some sectors and overall. And I think SOFTCAT serve all sectors. If their organic strategy goes wrong, something goes wrong with their sales force and their account managers, and it just starts going wrong, and then their revenue starts dropping, that'll be something to look out for. And if there's an end in this trend of companies modernizing their IT infrastructure, but I have to say that risk is fairly unlikely. So I'll speak to you again when I do my next video, which is probably going to be inflation busters as a stock filter idea, although that's not 100% yet. That's where I'm erring towards at the moment. So until then, happy trading.